Thank you so much for taking time out of your busy schedules to be with us today at the live market analysis for May 26, 2016, an overview of key markets with Juan Maldonado and myself, Jody Samuels. Please read the disclaimer to yourselves, and thank you. Today we are going to do some cross-market, intermarket analysis to show you how the markets are linked and what you can look at to get clues in your own trading, followed by Elliott wave analysis on these key markets. In particular, we will look at the key market drivers, what's driving the markets today, some of our scanner trends, followed by wave counts on oil, the S&P, the Euro USD as a proxy for the dollar, and gold. So in the past big picture analysis webinars, we have followed the risk on and risk off stories and have looked at oil, stocks, the euro for the dollar, and gold. We've looked at the market correlations to see how intermarket analysis plays out in these four market sectors. And we have made the case that while there are different market drivers at any point in time, currently the drivers are U.S. economic activity and when the Fed will continue to raise rates in 2016. We have also made the case that the stability of the price of oil was a key factor in the Fed's decision-making, and therefore have argued that stock traders need to track the price of oil. One could argue that certain currencies also played off the commodity theme, such as dollar Canada, the Aussie, and even the Norwegian kroner in the case of oil, which we will shortly see. From the Fed's perspective, stability in oil prices and other external factors have played a role in addition to U.S. domestic growth and inflation targets. So is the Fed on target for raising rates? Let's see. We're going to talk about 3 points today. The first is oil. As crude oil breaks $50 earlier today and rallies to a 7-month high. This is a chart which shows the last time oil was at $50 a barrel, which was on the week of October 11, 2015. So we are at a critical psychological level and key resistance area, which is why it has bounced off of that level in the last several hours. So this news, this week, the news which propelled oil higher was the EIA data released on Wednesday, even though it was certainly on track for hitting $50. I mean, clearly the market was pushing for the $50 area. But what happened was American crude stockpiles, which are near an 8-decade high, fell by 4.2 million barrels last week, and the consensus was a fall of 2 million barrels. So the EIA data showed U.S. stockpiles fell as imports dropped and refineries cut output in a sharper than expected fall in inventories. As a result, oil prices continued to rise on Wednesday, and gains in energy shares lifted world stock markets. On the other hand, some of the world's biggest producers continue to pump crude at near record levels, and OPEC is unlikely to set an output target when it meets June 2nd, as it sticks with Saudi Arabia's strategy of squeezing out the rivals, according to all but one of the 27 analysts surveyed by Bloomberg. So this should put a cap on oil prices. Now let's look at the stock market with the oil price overlaid on stocks. And this is where the EIA data was released. Right now, oil had sold off into that number, and then it quickly rebounded and moved much higher and hit the $50 target right over here. And what happened to stocks? Stocks continued to rally until the $50 peak, and they both sold off. So again, very strong correlation between oil and the S&P. Now let's look at the oil with some of the commodity currencies that I spoke about. So this is the US dollar Canada with the oil overlay, and there is an inverse relationship. This is the US dollar Canada, which means that as the US dollar Canada moves down, it's the US dollar moving down and the Canadian dollar strengthening. So as oil strengthens, so too does the Canadian dollar. And look at how both turned around today. In fact, going back to when the EIA data was released, and we already mentioned that oil sold off, so too the dollar Canada rallied a little bit, and look at this very strong red candle on that data release. And since that release, the dollar Canada traded down 140 pips yesterday into the evening, and then another 100 pips overnight. So if you were watching US dollar Canada without knowing about the EIA release at 10:30 yesterday, you would have seen the dollar Canada drop and wondered why. And if you were watching the dollar Canada without oil on your screen, you would not have seen the direct correlation. So oil traders need to watch the dollar Canada, and Canada traders need to watch oil, even though it's really the oil that's moving and driving the Canadian dollar. But it's a good confirmation when you're trading either market. And look what happened this morning, subsequently. Oil bounced off the $50 and the dollar Canada bounced off its low point. So Canada weakens. So I can't stress this enough that we need to watch the market correlations. Now, the other currency that I want to highlight is the Norwegian kroner. Same story. The Norwegian kroner is very sensitive to oil prices, and you can get the Norwegian kroner on your trading platform as well. So look at the price of oil, and it too has an inverse relationship with oil. So it too, as oil strengthened, the US dollar, Norwegian kroner sold off. So that means a stronger Norwegian kroner, and both turned at the exact same point. I mean, this was almost a layup, knowing that $50, well, you know, $50 is such a psychological level, and then both the dollar Canada and the Norwegian kroner turn around. So I just wanted to bring these to your attention, and you're not going to get as clear signals as perhaps we had today at a $50 psychological level, but certainly you can see the trends. This is an hourly chart, and you can see the trends and the correlations being followed. So the question is, will oil continue to rally? So I want you to stay tuned when I'm done with this analysis for Juan's Elliott wave analysis shortly, where he will give you the US oil wave count. So stay tuned for that. The second point that I want to discuss is, of course, the Fed, because that's really what's driving all of this. And there has been a lot of Fed rate hike chatter this week. So, for example, earlier this week, San Francisco Fed's Williams said it would be a good idea to raise rates with inflation below target. Last weekend, Boston Fed's Rosengren said that most of the conditions for more rate hikes that were laid out in the FOMC minutes seem to be due to the lag in policy impact. So there is improving confidence in the financial markets, and that is tempering anxiety over the Federal Reserve's plans to raise U.S. interest rates potentially as soon as next month. In fact, traders are now pricing in a 1 in 3 chance of higher borrowing costs in June, and that's up from 4% last Monday. And July is the first month with more than even odds for a rate hike for those bettors out there. And don't forget that Fed Chair Janet Yellen is scheduled to speak on Friday after the European markets close, so stay tuned for that. Well, after the release of the Fed's April meeting minutes, the markets seem to have grown comfortable with the elevated odds of a U.S. rate hike in the next 2 months. Since the traders are now pricing a better than even chance of the central bank boosting rates in July and possibly sooner, we have to act on that information, and certainly the market is acting on that information. The key point is that before, there was a feeling that higher rates would be bad for the economy. There was a lot of uncertainty, a lot of anxiety. The Fed didn't know what was this. I'm going back to even the fall. With the oil prices collapsing, oil needed to stabilize, which it has done. And there was just too much uncertainty. So finally, the market has digested all of that information, all of the bad stuff, and the market is now looking at a rate hike as a sign of economic strength. That's what it's doing. The next few months should be very interesting because we're going to see a new set of scenarios once the Fed does start to raise rates. Now, the third point that I want to talk about today is gold and the dollar. And gold and the dollar continue to track each other. This is one of those intermarket or cross-market relationships that have remained true over time for the last several decades, and the relationship continues to hold. And here we have an hourly chart, and I'm just showing the hourly chart to show you how correlated gold has been with the euro all week long. And I'm using the euro as a proxy for the dollar. Now, certainly it's the euro. When the euro drops, it's the US dollar strengthening. You have to look at gold and its inverse relationship to the dollar. When gold drops, the dollar rallies. So in this example, gold has dropped significantly all week long, and the euro has dropped as well, meaning the dollar has rallied. And then yesterday, the market settled down, and both markets have found some footing to correct this move down. In fact, what is the reasoning behind this? Well, gold continued to drop this week with the prospect for higher rates closely approaching. And gold is off from its highs of 1303, and it traded as low as 1218 yesterday. So down $85 from the price highs. That's quite a large drop. And as I said, the traditional and historical relationship between gold and the US dollar has held over time. The Aussie also tracks very well with gold. So Canada tracks well with oil, and the Aussie tracks very well with gold. So make sure when you have a look at when you're trading gold or you're trading the currencies, you want to look at gold and the Aussie together, because you can see some correlations and you might get some direction from the other market that you're not trading. And the same with oil and the dollar Canada or the Norwegian kroner. Yes, I mean, you could say that trading the Canadian dollar and the Norwegian kroner is like trading oil. But in fact, we also saw how the S&P has also mirrored oil. Now let's look at all the markets that we've talked about. And I've shown this chart in every market webinar previously, where we have oil, the S&P, the dollar Canada across the top. Today I put in the dollar Canada instead of the dollar yen because we talked about it. And then down below we have the euro, the German DAX, and gold. And today I have the 4-hour chart up instead of the daily chart, just to see in recent times this week what all the markets has done, and to see these correlations more carefully. So starting with oil tracking higher and of course selling off at this key psychological area, resistance area. Well, so too, if you look to the right at the S&P has tracked higher with the price of oil, And it too has a strong red candle at this level. It has to. I mean, it's tracking oil so well. Naturally, traders are going to take this as an opportunity to go with the market that the S&P is tracking. We also happen to double top here in the S&P. So that means that the S&P reached its 4-hour peak before oil did. So that's something else to note. And looking down at the DAX, you can see also a red candle. Okay, so the DAX selling off a little. The dollar Canada to the right, again, this just shows the inverse relationship as the US dollar Canada drops. That's the Canadian dollar strengthening with the move up in oil, and it too has a nice, almost an engulfing candle with a long tail on this 4-hour chart, a market reversal point reversing with the 4-hour oil candle. Okay, so strong correlation here. Looking at the euro and gold, the euro has tracked down. That means dollar higher, and with gold trading down as well. Inverse relationship, gold lower, dollar higher. So those are the relationships that we need to continue to look at. I just want to move to the scanner before I turn it over to Juan, who's going to show us the wave counts on oil, the S&P, the euro, and gold to see what we're looking for. This is the scanner, and all I did was I put together the 4 markets: oil, the S&P, euro, and gold. And this is the looking at the 4-hour. Well, if we look at oil, oil has been tracking bullish, and then the 5-minute turned red within the last 5 candles. So it triggered a short, but oil has been long since 41.10 on the 4-hour, on the 4 hours. And the current price at the time that I took this earlier today was 49.65. So it had already sold off from the 50 mark. On the S&P just went long on the 4-hour, and it's been long on the hourly and the 15-minute from lower levels, current price 20.88. And it went orange, which means that it's not long, it's not short, but it's a warning on the 5-minute at 20.90. The euro has been short on the 4-hour from 112.15. The shorter time frames went long, and it's been short on the weekly since 127.50, and gold has been short on the weekly since 13.88, current price 12.22, and it triggered short at 12.44 on the 4-hour and 12.57 on the 1-hour. So that's the scanner. So now I'm going to turn it over to Juan, who is going to show us the view, the Elliott wave view on oil, the S&P, the euro, and gold. Over to you, Juan.
Thank you, Jody. That was great. Hello, traders. Thank you very much for being here with us today. My name is Juan Maldonado. I'm going to explain our view on the markets using the Elliott wave technique. If you are new to Elliott wave, don't worry, it's actually simple. The main idea is to understand the direction of the market. The Elliott wave analysis is not going to provide the signal to find trades. It's analysis that will help us with the direction of the market. And the main idea, the whole idea of the wave theory, is to find those waves and especially validate the end of the waves using other techniques, such as trend lines or candlestick reversals, or any other technique that we want to apply to validate the end of the wave. So that's important to keep in mind during this analysis, that always we need to validate the waves, and just because the labels are there, it doesn't mean that the market is going to that level, because we need to validate first. Very good. This is the Euro USD on the weekly chart. We are in a corrective wave since March the 29th. The price has been sideways. You can easily see that. We are having here three waves. If we look to the left, the decline since May the 4th, 2014 ended at this low. That was in March 2015. And after that, the price started the consolidation. When you have in a technical analysis, a move can be bullish or bearish, in this case, bearish, and the price starts consolidating, we know that as a pennant or as a flag. It's a continuation pattern. But the main question is when it's going to end. How we can know, how we can find the end of that corrective, because we can't wait until the breakout of the lower trend line, especially on the weekly chart. We can't wait until the price goes down and makes that breakout. That will be too late. So the whole idea with this analysis is to find the validations before, to find, for example, if our Elliott wave B is complete, in order to start following the trend and following the price to the downside, and of course watching how it's going to react at the previous low. So we will have all this room, and I will talk about the validation insight in a second, but we will have all this room to the downside in order to find our trades. And this will work if you are a day trader, if you are a scalper, if you are a swing trader. This will work for you because you will know the direction of the market. Then once the price hits the support, that will be around 105.35, we will check again the price action. We will check the structure. We will see if it's going to make the breakout, or another scenario could be that the price wants to make another corrective and keep making correctives inside for longer. But we will know that once the price hits the support, because we will have the information for the move down. Well, that happens, we can do a lot of things inside. So let's start talking more about the internal wave count and how we can validate the end of our B wave. The daily chart will show us more candles. So here we are. We're on the daily chart. Let me hide again some waves to make these more clear. Okay. So one of the basic techniques in order to know if you are in a trend or not is the trend line. I'm going to start my trend line from December 3rd, 2015, all the way up, connecting the retracements. So the retracement that I use is this one here. And mainly what the trend line is saying is that while the price remains above the trend line, is bullish. And once the price makes the breakout of that trend line, it will change of trend from bullish to bearish. So that's the meaning of the trend line. Once that happens on the daily chart, we will have the validation that our B wave is complete and that we are in a new cycle. While the price remains above the trend line, the B wave could be active, and I will explain better the inside waves in a second to have a better perspective and to build a trade plan. So if that's the case, in case that our B wave is active, an alternative scenario will be that the price bounces off the trend line and can make a new high. So we have to be ready for that. But the good news is that we can know that before it happens. So in order to solve that question, the next time frame will provide more details in our research. This is the 4-hour chart. So again, I'm going to hide some of the waves. I want to keep it simple so you can understand what we are looking. One of the characteristics of the Elliott wave theory is that when we are in an impulse has 5 waves, and you can learn the wave theory with us too. We have a fantastic course. Then when we have a wave 1, a wave 2, and then the wave 3 is the strongest wave. A wave 3 is the strongest cycle. Is going to be powerful. The slope is going to be strong when we measure it with the awesome oscillator. That is the oscillator that we use to measure the strength of the waves. But in this case, on the Euro USD, we don't have a wave 3 yet. Because look, the price went down, retrace, down, retrace, down, retrace, down, retrace. If you're asking, but how do you know that there you don't have a wave 3? Well, that's easy. The S scenario, in case that we have a wave 3, will be like this one blue, a strong wave 3. A wave 3 is not going to be with this kind of personality, so sideways and choppy. A wave 3 is a powerful wave. So we have pending that wave 3 in our analysis in order to have the confirmation on lower time frames that weekly big wave that we are studying ended. So we have to be careful with this slope because we don't have that strong wave 3. Now let's talk about future scenarios that we understand the slope and we understand why we're thinking that and why we don't have actually the validation. Okay, so the scenario that we are looking in order to validate our bearish wave count will be to see the wave 3 here, because the price can extend. So if we have the wave 3, currently we have a strong move down, and the awesome oscillator gains momentum to the downside, we have a stronger lecture on the awesome oscillator, that will confirm in terms of the wave count that the B wave ended. And you remember also the weekly trend line and the daily trend line that we were working with, that will be also that breakout with the wave 3. Once that happens, we can follow the trend with all the retracements. So that will be our bearish view, the bearish scenario is our main one. Anyway, because we don't have the validation yet, we need to be careful with this structure, because as I explained on higher time frames, this could be a connector wave, an alternative scenario that the price can make then a new high. So how we can tell, how we can know, and that's easy to find. If we have the breakout of this red trend line before having our wave 3, we are going to start looking then for that bullish scenario. Because if we are in the structure for the wave 3, we don't want to have a change of trend in the middle before the wave 3. So in that case, this will be the bullish scenario, our alternative. In that case, if we have that breakout, there we will have 5 waves and 3 waves against the 5. We will add our trend line, and we will activate the bullish scenario right there at the breakout of that trend line. So remember, bearish scenario, if we have right now, and we need it now, the strongest move down in order to add momentum, and after that we start validating the internal waves and adding to our positions to the downside. Or bullish scenario will be 5 waves up, breakout of the trend line, and 3 waves against. If that happens from this level, from the 112 area, we will know that we are going higher to reach the previous high. If we have the strongest leg to the downside, we will know that our weekly wave count is valid, and we just follow the trend. So you can see that Elliott wave can help us with validations and invalidations. An invalidation is a validation for an alternative wave count, but the key is to understand where and when we can find our trades. Very good. Oh, here we have a question. Wave 3 may not be the longest wave, but it can never be the shortest wave either. That is right. The wave 3 can be the intermediate in terms of length, and the wave 5 can be the longest, the wave 3 in the middle, and the wave 1 the shortest. That is true. Okay. Now let's continue with the next one, that is the S&P. If you have been in these webinars before, we have been talking about the S&P that is making a corrective wave. So what we're finding is that the price is building a corrective wave. That's easy to see. So we have a move down, a retrace, and a move down, and a move up. What we are going to solve with Elliott wave is if this sideways structure is over or not. Because in case that the sideways structure is active, what we are going to see is another leg down. And then it could be the end and the price can continue. Because eventually the S&P will continue because we have nice momentum on the previous swing up. It's just making the corrective. So we have to be very careful understanding well the structure inside in order to have some nice validations. Well, the sideways corrective sequence is there, and I'm going to demonstrate using Elliott wave that the move up is actually another connector wave, and we are at the top of the market, and the plan, we're close to that validation, I will show it in a second, and the plan is that once it validates the connector wave, we can start planning the bearish scenario with a target at the previous low area, 1848. I am not saying that the price currently is going there, that we have the validation, because we don't. That's why I'm going to explain the internal and the Elliott wave count so we can plan the validation together. Daily chart. Oh, actually, let's go to the wave count. Okay. So this is our wave count. Let me hide, first of all, some of these waves. There we go. And as I explained on the weekly, we are seeing this leg up as corrective. We have some guidelines, we have some rules, some validations with indicators. And the price last week started to move down. Well, actually, during the last week of April. And we're having a nice pattern currently that is expanded flat. You can see it. The price tries to break out the low and it fails and reverses, and now is breaking to the upside the previous pivot, 2048, or the previous retracement. So that's why it's expanded. You can see that it's expanding right there. An expanded flat for the wave 2 is not common, is rare. Actually, the wave 2 usually is a zigzag. So that's a warning. Anyway, let's go to the 4-hour chart and validate together the bearish scenario. And of course, to explain where this wave count will become invalid. The previous high, 2112, where the connector wave ended, that was around April the 20th. So we have the price that reaches the level, and then it started a nice 5-wave sequence. 1, 2, 3, 4, getting inside of the wave 1 because it's a leading diagonal wave, that is valid. So 1, 2, 3, 4, 5 for 1. Then A, B expanded, and C. So in Elliott wave, once we have an expanded flat, we can label A, B, and C, where the wave A will have 3 waves or combination, the B wave the same, 3 waves are combination, and the C wave always a 5-wave sequence up. But don't forget the invalidation, because we are close. We're pretty close to that invalidation, 2112. So let's see the hourly chart where we are going to plan the validation for the end of the wave 2. And this is fantastic because you can see that we are doing the top-down approach and all the time frames are saying the same. So that's important with Elliott wave, that it helps us to understand better the markets, because on the hourly chart we are taking care also from the structures on the daily, on the weekly chart. So we bring all those structures on higher time frames to the hourly chart thanks to the wave count. Okay, so let's add here a trend line. And the price currently is building that 5-wave sequence for the C wave on the hourly chart. 1, 2, 3 sideways for the wave 4, that is there, and then the wave 5. We're expecting the wave 5 to be somewhere below the 2100 area, because remember that the invalidation is at the 2112. So the wave 2 needs to end before that. But the main validation will be this trend line. Because mainly what we are saying, if the price starts going down and performs the breakout, we will know that the wave 2 is over. Of course, if before doesn't invalidate the wave count. Then, waiting for validations is important, because just having the label there, it doesn't mean anything until the wave count validates. Also another detail that we would like to see in the future is divergence between 3 and 5. That will be extremely important to validate our ideas. We are not going to try to do anything without divergence when we are looking at the change of trend. And a quicker or faster trend line can be used once the wave 4 red is over, in order to have a quicker confirmation of the end of the wave 2. So mainly the plan is sideways, a little bit more of price action to the upside to give us divergence, then breakout of the red trend line, visit to the other blue trend line that will be the next support. If it breakouts, pullback, of course the markets are going to be fractal, so it's going to move, it's going to make retracements, but that will be the validation that we are looking for. Always wait for validations. Very good. The next instrument we are going to check is oil. Oil is moving higher, has been moving higher during this week. The price reached the bottom at the 2611, and it started to move up. So let me hide some of the waves to explain this easier and you can understand it better. So we're thinking that the move up since February is a 3-wave sequence, and actually you can see it easily here. We have 3 waves up here, 3 waves to the upside. When we're expecting an impulse, or when the market is doing an impulse, we will have 1, 2, 3. 3 the strongest. But look, right here, that third leg up is inside the channel, and actually is kind of compressing. That price action is losing momentum, And I will show another fact on lower time frames in a second to demonstrate that this is corrective. This is not an impulse. So a corrective wave can retrace 38.2, 50, 61.8, can invalidate, can perform, can be very deep, whatever, all the things that a corrective wave can do. But the plan is to validate the end of the wave. So that's what we are going to do in lower time frames, because our forecast is that once our wave X is complete, the price is likely to continue and visit the previous low area. But not yet. The price currently can continue going lower, going higher, sorry, and it can go to the 60 area. We don't know. So let's go to the 4-hour chart in order to have a better perspective of the inside wave count. On lower time frames, the price on the 4-hour chart is divergent, is losing momentum. So here is losing momentum. The divergence itself is not a signal to take a decision. So the trend line on the 4-hour chart, here we can have our trend line very easily, will validate the end of the structure. Once we have a breakout of that trend line, and we will check inside also the 5-wave sequence. It's important to validate the breakouts with the 5-wave sequence and the pullbacks. That will be the validation. 1, wave 2, and after that the wave 3. This is also known as a 1, 2, 3 reversal at the top of a market. So that's going to be the plan for oil. While the oil remains above the trend line, it can go higher, but we know that once it makes the breakout of the trend line, 5 waves inside, 3 waves against the move, 1, 2, 3 pattern, or the validations that you like to use, that will be the beginning of the next cycle, of the next move down. And finally, we have gold, that the price has been retracing. It's similar, for some reason we are having a lot of expanded flats in other markets as well. The same on gold. Look, we have the completion of an impulse and now it's expanding for the wave 2. So our forecast is that once we have the completion of the wave 2, I will talk about targets in a second, we will get a 5-wave sequence to validate, 3 waves down. The breakout of that trend line right there will be like a swing confirmation that we are going higher. For now, let's focus in the C wave of our wave 2. And about FIBO targets, I like the 38.2% of the previous leg. That's the 1190 area. On the 4-hour chart, the C wave blue is going to have 5 waves inside. We are currently in a wave 3. On the hourly chart, we can see more details. So mainly, when the market is making a structure like this, the strategies are finding the end of each retracement. For that, we use, for example, some stochastics, an indicator that we teach in our course that is called the bungee, that is going to provide enough information to know when those retracements are over and when the price is likely to continue. So the plan is easy. We find the end of the corrective waves with our system, and we use Elliott wave to follow those trends. Then the price makes the next retracement, and we do it again, and we follow the trend. So that's the main plan when we have trending markets, and we apply the wave count. We come from the daily, the 4-hour chart in order to understand better the market and just follow the waves, retracement, continuation, retracement, continuation. Well, so thank you very much for listening to my analysis. Now Jody will continue with the webinar. Have some fantastic trades during this month.
Thank you, Juan. So from Juan's analysis, I hope you get a really good idea of what we're looking for in terms of the four markets that we've discussed today. And I hope you do understand the wave counts. Juan was very clear with his wave counts and stressed the importance of validation at the end of trend moves, so that when we do have a market reversal, we can validate that market reversal. That is really important, because if you don't have that validation for the market reversal, the market can continue to move in the trend. So we want that validation. So I want to thank you all for being here today. We love doing these monthly live market analysis webinars. We are always open to emails, so please email support@fxtradersedge.com. If you would like to join our Elliott Wave desk, you can look at fxtradersedge.com/EWD, and you will get this kind of analysis on a daily basis. And if you are interested in our charts, they're motive wave charts, you can get 2 free weeks, a 2 free week trial for motive wave at bit.ly/EW, capital EWCHARTS, Elliott Wave charts. So thank you very much, and we look forward to seeing you again next month. And please keep in touch and certainly send us your questions.